started.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. It's been a strong first 6 months of the year with U.S. equities up nearly 14% year to date. But the question is, do equities have enough juice in them to continue this pace for the final 6 months of the year? Well, I have the perfect guest on to help answer that question and many more that investors are currently facing. I'm very excited for the next guest as it's going to be a very engaging and fun conversation, and one that I'm sure is going to provide us with a lot of insights on what to look forward to moving forward in markets. But first, today's episode is sponsored by the award-winning Zephyr, which helps advisors, wealth managers, financial analysts, and investment professionals make more informed investment decisions. All right, enough from me. Let's move on to the start of the show. Our guests. I'd like to welcome Cliff Corso. Cliff serves as the president and chief investment officer of Advisors Asset Management. He joined the firm in 2021, bringing a 35-year reputation for strategic leadership and his deep understanding of the financial markets. He is responsible for overseeing asset allocation and investment management across the firm's $40 billion in assets in the day-to-day management of AAM. So Cliff, thank you so much once again for coming on the show. It's really a privilege to have you on. Is there any additional information that I missed in that very brief bio that you would like to add?
Well, first off, thanks for having me, Ryan. I appreciate the opportunity to speak with you today. I guess maybe thinking back 35 plus years, almost 40. I know I'm dating myself there. I started my career in the mid 80s. I didn't have a mullet, but I did have a very, very wide tie, which was very stylish in the day.
Right.
But it was very wide. Held a variety of positions. I started out working for a commercial bank. I was a credit analyst and a lender. I lent across a whole host of different industries into the late 80s and early 1990. I saw my first recession and learned a lot about credit during that recession. I like to tease, I lent a lot of money. I got most of it back. And so, really that's where you form a lot of, life's lessons by seeing the cycles. And, I've been through a few cycles now, obviously. But I spent the lion's share of my career in asset management. Better part of 25 plus years out of that 35 plus year career. Held positions as a portfolio manager across many different sectors of the market, almost any sector you can name. As well, I held positions as the chief investment officer of an institutional fixed income asset manager that was about a $60 billion firm called Cutwater, which I helped found. And so I've seen a lot of different things. I was toting it up right before our chat here, 6 plus recessions. When I started, the 10-year treasury rate was at 13%. I watched it go to zero or near zero throughout those years. I don't think it's going back to 13%, but I'm sure we'll talk a little bit more about that. But I think that's plenty on my background.
Very interesting. There's a couple of things that we have in common. And one of them is, as you could tell, I never had a mullet either. I never really had the opportunity to. And very interesting you bring about 13% treasury yields. We think, 10-year treasury yields at 4%, after couple decades of very low yields, what that was like as an investor where you could get, somewhat of a risk-free rate at 13%. What a time.
No, incredible time. I was my wife and I bought our first house, and my mortgage rate was, I think, 12.25%, and we were doing cartwheels because a couple of years before that it was 18, 19%. So yeah, it's a lot of it is perspective, as I think you're pointing out. Yes. 3.75% 10-year treasury didn't feel too good compared to the last decade, I guess, but it's not a crazy high number. Right. By way of last 20 years.
Right. Years. Yeah, you're exactly right. Perspective, right? we're complaining about mortgage rates at 6.5%, 7% right now, right? When, historical average, it's probably, the neutral rate probably should be about 5%, 4.5%, and we're really not that far, right?
If you look a little bit forward at where inflation numbers are forecast in a consensus way, your Taylor rule, the sort of quantitative metrics would have us, not too far from what you just said there, Ryan.
So that's fantastic, Cliff. Great way to start this conversation. So as I mentioned, equities have had a fantastic first half of 2023. And when you consider taken to the 2020 lows, equities are, right around that bull market territory. Can we expect more of that the same during the second half of 2023, or should investors kind of cool their expectations?
Well, I think a lot of what's going on here, it's certainly been obviously quite a start to the year, not really in any mainstream forecast, right? Most people, including ourselves, were expecting a recession, maybe not a hard one, but a slowing economy into a recession, that not necessarily the mixture for continued equity rally. And so we've had almost beyond a year's worth of returns, in a half a year here, and a whole bunch of reasons why that is. And remarkable in the face of rates rising with the Fed, not yet done, maybe getting close to done, but still raising rates. We've had sticky inflation, which we think is still a little bit of a challenge. The Fed is talking about that in Portugal last couple of days, how sticky that is and the challenges. And then, of course, the continuation of the war. And now recently, who knows what will happen in Russia with all the strange things going on there. Yet the market, kept on rallying. And I think a big part of that support in the market is the expectation that the Fed is, if not done, right there in terms of being done. So we can, the market's saying we can kind of see our way clear now that the rate volatility is maybe closer to the rearview mirror. And so that's a big, concern removed from the market's, expectation. I think the challenge there is that inflation is still very sticky. And if we think about looking forward, not in the rearview mirror, but looking, forward, you see some challenges here still to the market that could create a headwind for the market. And by that, I mean, as I think many have been talking about, the concentration that's really in these 7 stocks, the so-called magnificent 7, that have really been doing the hard work of raising that whole index. The rest of the S&P is up a couple percent, so not so dramatic. A fair amount of that concentration, I think, is related to long duration stocks, expectation that rates are stabilizing and the Fed is done. We don't necessarily see it exactly that way just yet, because if we look at the framework of what the Fed needs to do to get inflation off its sticky level of this 4 to 5% range, which is still very far from the 2% ultimate target, they have to, if not raise a little bit more, and we at AAM are not forecasting significant spikes in the Fed funds rate, but maybe a couple more moves. But really what the dynamic is going to be in the second half is the Fed's not going to pivot, in our view, to lower rates, which the market had expected. We think the Fed's going to hike and hold for quite a while, and that inflation will still remain sticky. And if you look at historic regimes of inflation in this 4-ish% range, it's more highly correlated with a PE ratio, a valuation ratio, somewhere more in the 13 to 15 times as compared to the 20 times forward PE ratio in the S&P today. So we think there's still going to be a little bit of headwind here as we move through the back half of the year. Also think the way the Fed is going to need to try to get inflation down is to do more damage to the economy. They're operating with very blunt tools. And really the main way they're going to try to accomplish this in the second half is by increasing the jobless rate. That wages being a very sticky component is what they're trying, one of the areas they're trying to slow down. The other one is a little bit ironic. One of the most rate sensitive sectors in the economy is real estate. And the interesting thing about the Fed trying to destroy demand with its blunt tool less consumption, less money to spend. It has also, in essence, destroyed supply offered into the housing market. Because I mentioned my mortgage rate before, my first mortgage rate was 12 and a quarter. I'm one of the lucky ones. I count myself fortunate that I have a 3% mortgage.
Yeah.
And so even if I wanted to sell, boy, that's almost more of an asset than a liability at this point. And what's happened in the housing market is that secondhand homes, not new homes, but secondhand homes are the biggest part of supply. 5 million annualized homes available for sale historically. That number's been chopped down by 30%.
Mm-hmm.
So that's an ironic one. The most interest rate sensitive sector is sticky. And again, it's because the Fed has destroyed housing supply in addition to housing demand. So we see challenges ahead there. That's going to be a little bit of a tough back half of the year. And then I think once we see a little bit more valuation compression or correction, then can turn the asset allocation to be a little bit more aggressive.
But that was fantastic. A lot of great insight there and information and different ways of looking at the next 6 months. I think a lot of firms would agree with you that this first 6 months it's a surprise when you consider the Fed has tightened. But at the same time, markets have been very resilient since the pandemic. And I think it's caught a lot of people by surprise. And it's just really been a rotation this year compared to last year, the performance from last year. As for real estate, I recently read something very interesting. You talked about 3%. It's like 70%, and I'm earmarking, ballparking it, 70% of mortgages are under like 4% mortgage rates or something very low. And if I've got a mortgage that's 3%, unless my household is getting a lot bigger and I'm having twins or something like that, why would you sell and buy a house and you're doubling your mortgage rate, right? So very interesting insight there.
No, I think, Ryan, you're spot on. It's very challenging because obviously the new mortgage rate is 300, 400 basis points higher than the low number of 3%. And if you're sitting in your home, and as I've said earlier, it's typically, obviously, it is a liability. You owe the money, but when you're so far below the current, spins that whole thing on its ear, and it's an asset. And I'm a bond geek a little bit. If you did some simple bond geek math, and so, well, Cliff, you said that's an asset. How would you ascribe a value to that? Well, if you took this 300 basis point differential and you assumed your average mortgage outstands for about 7 years, you could almost kind of think about it like a 7-year bond. And then if you do your just sort of bond geek mathematics on that, you'd be about 20% in the money in terms of valuation. So even though home prices have slowed and actually they're correcting back, maybe flattening out, your home prices have dropped a little bit, that's a 20% asset, just in terms of the calculation on the present value of your mortgage. So, it's no surprise, I guess, that people are not stuck. Well, maybe some are stuck, but are in their homes and not necessarily looking to, to do what we would see in a normal market, which is, have a lot of turnover. As you said, kids, moving up, bigger houses, so on and so forth. That's a very unique dynamic that we have not seen, in our careers.
Exactly. You talked about the Magnificent Seven, right? They've contributed tech stocks, Magnificent Seven, over 80 or around 80% of the strong year-to-date equity returns. Is that tech trade overdone, do you think? Do you think maybe we should rethink it moving forward?
I think there's a little bit of over enthusiasm in pockets of the tech sector. If you looked at word mentions, it's kind of a fun way to think about how much activity is going on in a sector or what's driving a sector. The word mentions of AI last year versus this year, it's exponential. It's up thousands of percent. So, I was teasing the other day here at AAM, what does AAM stand for? It's artificial intelligence asset. No, it's not.
All of a sudden, the inflow.
No, it's not. It's advisors asset management. But it's kind of, it does rhyme a little bit with what we saw in sort of meme worlds. And, I was in the markets during the last tech bubble, and this, phrase stuck with me, the new booms and internet and all that stuff going on. And there are survivors and, really obviously very successful companies. There's a lot of wreckage on on the floor. But one of the phrases that stuck with me, and I think it's true today, is, investors tend to overestimate the power and impact of new technologies in the short term, and they tend to underestimate it in the long term. And so obviously we're in early days of sort of this AI boom. So I think there's some, it's really hard to actually calculate. We all know about it, NVIDIA and the things we know, but it's really hard to describe, precise valuations on brand new technologies that no one knows exactly where they go. If one's going to play it, I would say play it in a basket. But I think it's, our opinion is it's a little bit over exuberant at the time being.
Yes, I would agree too. I don't think it's really that .com bubble type,
Right.
but you're right. In the near term, it's a lot of it seems like more of a speculative play. In the near term, yes, Microsoft, NVIDIA, they're going to be long-term plays and they might benefit, but there is some uncertainty there. Where are you finding opportunities? Typically I focus on equities and bonds, but go ahead if expand it to equities and bonds, if there's opportunities in the bond market too.
Yeah, sure. And maybe I'll start with equities and then flip it to the income sectors, because a big theme that we have is, if we look at the last decade, 2 decades, a lot of the return of the market has been driven by PE expansion. And part of the reason is because rates have gotten lower and lower and lower and lower through time. And so with lower rates come, it's sort of the mathematics of equity pricing, a higher PE multiple, and people will pay more for growth than income and value. And so we think that's, going to correct. And, we are very focused on the most predictable sources of return in a portfolio. And one of the most predictable sources is steady income or income generation. And that could be in equities, like dividend growth equities of quality companies, and certainly could be in parts of the fixed income market, finally. And I'll talk about that. But I would say, again, if we peel back, and I'll stick with equities for a moment, we peel back the onion on equities and remove those magnificent 7, again, teasing the nifty 450. Valuations are okay. PE ratios for the balance of the S&P or equal weighted has actually done quite well recently. I think valuations are okay, and it's really hard to time the markets. I think I'm sure many have seen the numbers. You miss a few days and you missed a lot of the returns. So we're not advocating, notwithstanding we see some headwinds, eliminating So we do like income. Income is a component of total return. Dividends as a component of total returns that dropped to 17% of total return in the last decade. Historically, that's been more like 40 to 50%. We think we're reverting to that space. So we do like income sectors of the market. Within fixed income, the Fed has finally put income back in fixed income. We do like that shorter to intermediate maturity part of the bond market, because the yield curve is inverted, meaning higher rates in the shorter maturities than the longer maturities. And we think that's the place to put some money to work. You can get 5 to maybe upwards of 6% yields on high quality corporates in sort of that 2 to 5 year bucket of the maturity market. The last time we saw those kinds of numbers was 2010-11. So it's been quite a while. And then even within high yield, and again, you might say, Cliff, what are you talking about? I think you were hinting at a potential for a recession. Why would you be talking high yield? Yeah. Well, it depends on where you are in high yield. If we are focused on the higher quality parts of high yield, where you can earn upwards of 8 or 9% in very, very strong credits without taking on a lot of rate risk. So we think that those are places to allocate. And then also alternatives. we're seeing a growth alternatives have been growing within the allocations within the wealth channel. And we see a strong opportunity for added diversification in alternatives and added income due to the nature of the private market nature of alternatives.
So really, when you're talking asset allocation, you're looking for quality, right? High quality equities and looking for income, consistent income streams, both equities and fixed income, with going more shorter duration and being more selective and high yield. Fantastic. And I'm going to touch on alternatives here shortly in a little bit. I think it's a fascinating space, but what are some risks in the second half? Monetary policy, there's some risk there for some investors. We always say don't fight the Fed. Investors aren't believing the Fed right now. Is there some risks there? We talked about high concentration of indexes and markets. What are some of the biggest risks you're looking at in the second half?
Yeah, and I think you hit a couple of big ones. I mean, the known risks are, I think ground zero is still inflation, because inflation has come down and from 9.1% at the peak CPI to sort of this four-ish level. So slashed in half, but no one should be surprised by that drop. That was, quote, the easy part due to the base effects coming out of the COVID lockdowns. The real hard yards are going to be from here ultimately to 2%. Now, Powell was just speaking again in Portugal at the ECB forum, and some of the quotes you'll hear from Powell himself are, we've got a long way to go on inflation. And so to your point, Ryan, the market is not priced in for the way the Fed is speaking at the moment anyway. And our belief at AAM is that inflation will be sticky, as I mentioned earlier. And so the Fed may be at this higher for longer position for a really long time, because the history, and certainly Powell is a student of the history and the Volcker regime, has been that you don't want to stop and start, because you elongate the challenges. So, Powell's probably going to, all else equal, barring a hard recession or a systemic risk, stick with it. And now other risks, systemic. Well, we had the regional banking crisis in March, kicked off in March. That's calmed down a lot. But another saying is the Fed tightens until something breaks. We had a little potential breakage there. We certainly did for the banks that didn't make it. That type of systemic risk, it's really hard to know what it is and where it's concentrated until it breaks. So that's the unknown, as Rumsfeld would say. Right. Other risks, could be just money flows, meaning we've had a lot of money crowding in, and FOMO, fear of missing out. Yeah. Could a recession hit? Again, our view that would create a recalculation on asset allocation. And as money flows in quick, money can flow out quick. So the volatility of the market and the equity market has been exceptionally low, but the volatility of the bond market has been exceptionally high. So there's a mismatch of views here. We think volatility could catch investors off surprise, and that could be lit by many, many things, but money flows could aggravate that volatility. And then geopolitics, it's really hard to do a calculation there. I don't think any of us a week ago would have predicted anything close to what happened in Russia this week. I had to look twice and say, am I reading or hearing this right? Somebody's on their way to Moscow with tanks, and Putin Chef sounds like a perfect name for a movie or a novel, right?
Yeah,
Putin right. But geopolitics this is a little bit of a regime change too. The world order seems to be repartnering up with China, trying to befriend Russia, at least for now. Us pivoting a little bit more to parts of Asia and Latin America. There's real recalculation going on here. That'll have consequences for sure. And by the way, just to go back to equity sectors, one we really, really like, and for reasons that maybe we don't really, really like, or that is the defense sector. I'm not happy for some of the reasons driving it. Right. When you think about asset allocation and guns versus butter, just given what's going on in the world, defense is a good long-term secular play and allocation. So, but again, that's another source of tremendous uncertainty,
Right.
given the changes going on in the world.
That's some great information and insights, and makes us think a little bit moving forward about different asset classes that maybe you didn't really think about, or that's not top of mind. You talked about alternatives, and this might really hit home to you, but private credit has been a hot alternative asset class recently. Is there any other specific asset classes or even private credit within that alternative space that you like more than others?
I think you hit a strong one there, Ryan. Private credit is a very strong growth component of the alternatives within the wealth channel. Others that have been growing strongly, and this one, you're probably going to peel the onion back with me a little bit, but real estate has been a core growth area within alternatives. And then not as big a sector, but one that's growing very quickly is the infrastructure sector of the market. And the common thread across those three, which we really like, is what I mentioned earlier. They're income generating sectors. You have a steady income and distributions from those asset classes, given the nature of the assets. But you also have growth opportunity within those asset classes. And so maybe no surprise that the big areas that are growing right now within wealth and are core, part of a core allocation within an alternatives sphere are those income sectors of the market.
Mm-hmm. There's a theme here when we're talking about asset allocation and the things you like. It's income oriented, right? Alternatives, dating myself, I've been in the industry 20 years now, and alternatives, in a lot of, whenever we talk about alternatives back then, it was REITs, right? That was kind of the most popular. It was accessible and so on. All of a sudden, though, it seems that I was just at an investment conference a couple of weeks ago, and it seemed like 85% of the panels were centered around alternatives. It was highly concentrated on alternatives. What has changed maybe in 5, 7, 10 years? It seems like that alternatives have become so much more popular than they were 10 years ago. Has there been a specific catalyst, like more accessibility, increased education and awareness of their benefits? What's been driving this popularity in alternatives?
Sure, and you're exactly right. Over the last 5 to 7 years, it's really begun to, from there to here, growing dramatically, and I think continues on as a secular change in terms of asset allocation. Really, a couple of catalysts, really. One, because institutional investors have been allocating to alternatives for the better part of 25 years plus. And part of that reason that is the benefits that to a portfolio that alternatives can provide when you begin to allocate into alternatives within your portfolio construction. They can help produce better outcomes in diversifying your portfolio and income enhancement. But the catalyst in terms of the wealth market has been twofold for sure. One is it's some of the pain points of investing in alternatives have been alleviated through some of the new structures that have been created for the purpose of offering to the wealth channel. If you look at some of the newer vehicles created, you might hear terms like non-traded business development company, by way of example. Those are actually registered funds. And so what that does for the investor is it simplifies the documentation. It simplifies the tax treatment. These aren't, K2 filings. They're 1099 filings, and so it removes the significant pain points. They also do provide for limited liquidity, not daily liquidity. That's not what alternatives are actually meant to do. They're actually meant to do a little bit of the opposite, which is provide the ability to harvest the illiquidity premia that is offered when one invests in private markets. Mm-hmm. And so they're part of a portfolio construction. But the vehicles now do provide for some liquidity, which is another improvement. So a lot of the headwinds and red tape of days past have been removed. And the other is just the challenges of asset allocation in a world where, the traditional model of 60-40 stocks bonds has, seen some bumps, to say the least. And obviously last year was a terrible year because both asset classes were down. This year, better. But if you look forward, and I think the way investors and financial advisors are thinking here, particularly if one does believe in a little bit of sticky inflation, is I'm trying to earn a real return in my asset allocation mix. Historically, that nominal return has been more like 8%.
Yeah.
I mean, if you look at most consensus forecasts for that 60-40 mix, it's more expected in the next 5-7 years to be more in the sort of the potentially 6% range. So you have a gap between history and today looking forward, and that's before inflation. So if you plop on one's inflation assumption, again, ours a little bit more sticky, those are suppressed returns. So what alternatives can do, as I mentioned earlier, in an allocation is add not only a little bit more yield, but also more diversification to the portfolio for a little bit of a smoother ride. And just some of the numbers that we've seen for the audience give you a sense of the degree of change. If you're looking at or talking to CIO offices and some of the broker dealers, wirehouses and the like, the estimated or expected asset allocation in alternatives, there's some way you're going from 3 to 5% today to 15 to 20% over time. So there's a secular journey occurring that has a long, it's a little bit of a long wave to go here. And again, what investors are trying to capture is just better portfolio construction, removing some of the headwinds of just a straight 60-40 portfolio, and just having a better outcome for their clients, the end investor that the financial advisor is watching over.
Fantastic insight there, Cliff, on alternatives. It's a really interesting space. It's evolved a lot, like you said, through accessibility and even technology and so on. Great information there. So, fun story in the conversation. We've got a few minutes. Anything interesting you've seen recently that you'd like to share?
Sure. So I'm in New York City, and what's been really interesting is seeing just the flow of people and crowd within New York City or not within New York City. There's a big debate over hybrid versus, stay at work. And so I walk through Grand Central every day. Pre-COVID, you had to have sort of a mathematical calculation in your head walking through Grand Central at rush hour, because people are coming at you from all different directions and everyone's walking quickly. And so you develop this periphery vision. You could walk any way you wanted through COVID. And what's happening now is on Tuesday, Wednesday, and Thursday for sure, you need to get that mathematical calculation back in your head, which is good to see. We'll see what happens, on Mondays and Fridays, but which is still, you're able to wander a little bit more around Grand Central. But we'll see what happens to the Grand Central. That's my main beacon on what's the crowd up to in New York City.
That's great. It's good to see. I see it out here in Lake Tahoe, right? Well, Lake Tahoe is just completely different. During the pandemic, I've never seen so many people here in Lake Tahoe, just because everybody's trying to get outside, go somewhere from the Bay Area out of the city. It was an influx of people on the hiking trails and biking trail beaches. And that's kind of been one of my indicators how the economy is doing, is looking at how many people are in the line of people in Lake Tahoe, and there's no recession in sight when you look at it that way. Thank you, Cliff, so much for joining the show. It was such an honor to have you on with all your insight. Quickly, where can the audience get more information about Advisors Asset Management?
Well, I appreciate the time and thanks for asking. So if they're dealing with a financial advisor, they could check with their financial advisor or go to the aam.live. Okay. That's our website, aamlive.com is our website. So that's where they can access much more information on what we do and the solutions that we offer.
I've been on your website recently, the thought leadership that you all produce, your team produces, is fantastic. A lot of great information on there. So well done. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our podcasts on the Adjusted for Risk YouTube channel, as well as on Spotify and iHeartRadio. Thank you very much, and have a great rest of your week.